Welcome to the Deep Dive. We're the place that tries to cut through the noise and really deliver the key insights on critical business topics. Today, we are doing a deep dive into Affirm Holdings, specifically their first fiscal quarter 2026 performance data. Looking at these financial reports can feel, well, pretty dense sometimes, like translating hieroglyphics, but we've pulled out what we think are the essential strategic signals for you. And we really have to kick off with the big news, the headline announcement from the CEO. The U.S. partnership agreement with Amazon, it's been extended. Another 5 years.
Yeah, that's huge. Runs through January 2031 now.
Right. That's a really strong sign, isn't it? About long-term stability, partnership trust.
It absolutely sets the tone. And, management themselves called this quarter really great. When you actually dig into the numbers, you see why. It wasn't just about raw growth. There was a really strong focus on improving the underlying unit economics and, like you said, locking down those big strategic partnerships.
Okay, so that's our mission today then. Understand how they pulled this off. We're going to unpack that pretty dramatic swing they had towards profitability. We'll look at the acceleration in key growth areas, thinking like the Affirm card, those 0% APR products, and also peek under the hood a bit at the data engine that's driving a lot of this. And crucially, we need to analyze their efficiency philosophy, that RLTC metric specifically.
Yeah, the RLTC part tells a fascinating story about how they're choosing to, well, spend their profit, essentially.
So let's start with that big financial shift. It really was profound this quarter.
It really was. We're talking about a quarter where financial efficiency drove just a massive turnaround.
Okay, let's hit the headline figures. FQ1 2026 compared to FQ1 2025, the prior year. Gross merchandise volume, GMV, that's the total value of everything sold. It grew 42% year over year, hit $10.8 billion.
Pretty impressive scale.
Yeah, and total revenue was up 34% to $933 million.
Good numbers, but like you hinted, the real story is the bottom line, what that volume actually produced.
Yeah.
They flipped a net loss of $100.2 million last year
Right.
to a net income of $80.7 million this quarter.
That's a $181 million improvement in 1 year.
Staggering, isn't it?
Yeah.
And operating income did the same thing, went from a $132.6 million loss to a $63.7 million gain. This feels very much like a controlled strategic shift, not just, things getting better cyclically.
Yeah, that kind of turnaround suggests really disciplined spending, and that brings us right to their core metric, RLTC, revenue less transaction costs. For listeners who might not be super familiar, why is RLTC the key thing for Affirm, maybe more so than standard gross margin?
Well, RLTC is crucial because it specifically strips out the costs that are really variable in the lending business. So we're talking about the cost of funding the loans themselves and the provision they set aside for potential credit losses.
Okay.
So it gives you a much cleaner look at the platform's basic ability to make reliable revenue from every dollar of merchandise sold. So it isolates the platform efficiency from the borrowing costs or the credit risk fluctuations.
Got it. And their performance on RLTC this quarter was, well, pretty wild.
It was strong. RLTC grew 60% to $455 million.
But even more important was RLTC as a percentage of GMV. It hit 4.2%. Now, why is that number such a strategic signal?
Because, and this is the interesting part, it actually exceeded the company's own long-term target range,
Which is?
which is 3% to 4%. They
Yeah.
stated this philosophically. Think of that 4% target as like a ceiling or a thermostat. The CEO basically said when they run consistently above 4%, they actively start looking for ways to spend that extra efficiency
Spend it how?
by expanding the network, pushing for more GMV, more reach. They literally view 4% as an upper bound.
So wait, they're essentially saying they're too efficient right now.
In a way, yes.
And management is taking that excess profit margin and using it as capital to buy future market share. That's kind of counterintuitive for a public company.
It is unusual to state it so openly, but yes, they're deliberately prioritizing network growth today over maximizing every last bit of margin right now.
Okay, so what drove that efficiency gain that created this surplus?
It was mainly excellent management of credit risk and their funding costs. The provision for credit losses improved, and their funding costs came down. Combined, those two factors shaved off about 94 basis points, almost a full percentage point from their transaction costs compared to GMV. Yeah. And that's what pushed RLTC up to that 4.2%.
Okay, this sounds generally positive, but if they're intentionally pushing for more GMV, maybe lower margin GMV, aren't they risking sacrificing the higher yield interest-bearing loans that kind of built the business? Is there a danger of optimizing just for volume over sustainable long-term profit quality?
That's the exact tension their strategy seems designed to navigate. And it leads us straight into the product mix shift we saw this quarter. They are effectively spending that efficiency surplus by pushing products that drive high-frequency use and user acquisition, even if they have lower yield individually.
And you see that in the user numbers.
Absolutely. Active consumers grew 24%, hitting 24.1 million. And maybe more importantly, repeat usage is accelerating. Transactions per active consumer jumped 20% to 6.1. That stickiness, that repeat behavior, is critical for the network effect they talk about.
And what's fueling that repeat usage specifically? Is it the growth in the 0% APR stuff?
Exactly. GMV from their 0% APR products, and that includes the popular Pay in X short-term loans, was the fastest growing loan category overall, up 64% year over year.
Wow.
And if you look just at the 0% APR monthly installment loans, those grew even faster, 74%.
Okay, but 0%. Someone has to be paying for that, right? It isn't just free money Affirm is giving out.
Correct. It's overwhelmingly merchant funded. For those 0% APR monthly installment loans made through integrated merchants, about 95% of the GMV associated with them was subsidized by the merchant.
Why would a merchant do that?
Could drive sales, basically. The increased conversion rates, they pay Affirm a fee, so the customer sees a 0% offer.
Right, makes sense for the merchant. But pushing those 0% deals must have an impact on the average transaction size.
It does, yeah. As they push these often smaller, high-frequency zero-interest options, the average order value, or AOV, dipped a bit. It was $260 this quarter, down from $279 in the same quarter last year.
Okay.
And management basically signaled that they expect this trend to continue, a growing mix of these lower RLTC products as they chase that network expansion.
All right, let's pivot slightly and spotlight the Affirm card. That seemed like another huge growth engine, especially for their direct-to-consumer or D2C efforts.
Definitely. D2C GMV overall grew 53%, and the Affirm card alone drove $1.4 billion of GMV within that.
How much did the card GMV grow year over year?
135%.
Whoa.
Yeah, staggering growth. It's clearly the main engine for their D2C channel now.
And are people signing up for it?
They are. They added 500,000 active cardholders just in this quarter. That brings the total to 2.8 million.
Is it mostly online use or?
Actually, the in-store usage is incredibly strong too. Grew 170% year over year. People are using it physically.
So it's becoming a primary spending tool for those users.
That seems to be the goal. Their stated plan is to eventually offer the card to every single user acquired. They see it as foundational to acquiring and retaining users directly.
Okay, so all of this growth, this product mix shift, it really hinges on their core asset, which they emphasize a lot. Data. They talk about this network moat, calling themselves an information-rich message router. That sounds a bit like, well, marketing speak. What's the tangible benefit?
Well, the tangible benefit is supposed to be operational superiority. Every single transaction, every data point refines their underlying models for credit risk, for fraud detection. They have specific AI tools like Adapt AI and Boost AI. These tools use that constantly refined data to, ideally, approve more loans than competitors could safely approve, or approve them on better terms, or manage risk more precisely.
Can you give an example, like Adapt AI?
Sure. Adapt AI apparently works in real time. It dynamically adjusts the specific loan terms offered to a user based on their history and the transaction itself. The goal is to maximize the chance the user accepts the loan, but do it while staying within strict risk parameters.
And you can see this investment in tech reflected in their spending, right?
Oh, absolutely. Their technology and data analytics expense line item was up 25% year over year.
Okay.
And a really big chunk of that increase, it drove 43% growth within the line item, was from the amortization of internally developed software.
Meaning they're building a lot of this tech themselves and putting it on the books as an asset.
Exactly. They're rapidly turning internal R&D into usable, capitalized assets. The number of these capitalized software projects actually in service grew 59% in the year, went from about 1,000 projects to nearly 1,600.
That signals a deep ongoing commitment to building out that AI and data infrastructure. It's not just talk.
Right. It seems core to their strategy.
Now, beyond the card and their own platform, the partnerships seem to be really firing on all cylinders, too, diversifying away from just one or two big players.
Yeah, that's crucial for reducing concentration risk. Their top 4 wallet partnerships, for example, accounted for over $7 billion in GMV over the last 12 months.
And how fast is that channel growing?
Nearly 70% year over year. Really strong.
But it's not just the big guys, right? They're reaching smaller merchants, too.
Yes, and that's maybe even more impressive strategically. They're using what they call independent software vendors, or ISVs. These ISVs serve like the long tail of merchants, think smaller businesses, specific verticals like auto repair, medical services, professional services.
Okay.
GMV coming through those ISV partnerships grew 68% year over year. And that connected Affirm to about 27,000 different active merchants.
That's genuine network diversification, reaching places the big platforms might not.
Precisely.
And they launched a new product to help manage these integrations, Affirm Connected Accounts.
Yes, that seems designed specifically for this ecosystem play. It allows users to securely share their Affirm information with these partners. The idea is that partners can then offer more tailored Affirm solutions directly within their own platforms or workflows. It's sort of the necessary plumbing to make scaling across all these different partners smoother, especially in those service-based industries.
Makes sense. Okay, let's shift gears again. Talk about the bedrock, credit quality and their strength in the capital markets. None of this fancy growth matters if the underlying loans go bad or if they can't fund them cheaply. How did credit look this quarter?
The overall picture suggests continued discipline. One indicator is the number of borrowers needing help. Total loan modifications, things like payment deferrals or reamortizations for people facing financial difficulty, actually decreased. It was $8.8 million in total this quarter, down from $11.1 million a year ago.
That's a positive sign. What about actual delinquencies, particularly in the main monthly installment loan portfolio?
They held up well, especially given the rapid GMV growth. 30-plus day delinquencies were basically stable year over year at 2.8%.
Yeah.
And maybe more importantly, the more serious 90-plus day delinquencies actually ticked down slightly. They were 0.7% this quarter compared to 0.8% a year ago.
So, stable to improving credit quality. That must make the funding side of the equation easier. How were the capital markets for Affirm?
Yeah. Very constructive, according to the company, which is finance speak for really good.
Right.
Their total funding capacity increased to $26.6 billion. They estimate that's enough to support over $60 billion in annual GMV. So plenty of runway.
Any specific deals stand out?
Yeah, they closed their largest ever asset-backed security issuance, ABS. It's basically packaging up their loans and selling bonds backed by them. This deal, AFFRM 2025-3, was $1.1 billion. And significantly, it priced with the lowest weighted average yield they've achieved on an ABS deal since way back in fiscal year 2022.
So investors are clearly confident in the quality of the loans Affirm is writing right now.
That's what it signals, yes. Strong demand, lower borrowing costs for Affirm, and their overall liquidity looked healthy too, about $2.2 billion in cash and available securities.
Okay, one last area we need to touch on briefly, the legal front.
Okay.
Always important for investors to track major lawsuits. What's the latest on that Kuznier class action?
Right, that one was significant. It basically alleged the company made false or misleading statements about how vulnerable the business was to rising interest rates, which is, a critical risk for any lender.
What was the outcome there?
Good news for Affirm initially. The district court dismissed the action with prejudice back on September 30, 2025. That means the court found the case lacked merit and couldn't be refiled in the same way.
Okay, so that removes a big potential headache.
Well, not entirely. The stability is being tested.
How so?
The plaintiffs didn't give up. They filed a notice of appeal to the U.S. Court of Appeals for the Ninth Circuit just about a month later on October 29, 2025.
Ah, okay, so it moves up a level.
Exactly. And there were also 3 related lawsuits called derivative suits, Kuroga, Jeffries, and Valieris. Those are still on hold or stayed, waiting for the final outcome of the Bain-Kuznier appeal.
So the legal risk isn't gone, but the initial court ruling was definitely in Affirm's favor.
Correct. The core business practices were essentially validated by that first dismissal, but the fight continues at the appellate level.
Okay, let's try and synthesize all of this. It feels like this quarter wasn't just about things going well passively. It was about accelerated, very intentional strategic moves driven by product innovation, the card, the 0% offers, but all enabled by this financial efficiency gain, which, interestingly, they seem eager to spend down.
I think that's a great summary. The core thesis they keep pushing is that scale should make things easier because of their unique network effects of data. That swing to profitability, getting RLTC above 4%, it gives them the financial firepower to really push hard on expanding the network, getting more users, more merchants, more data, all while, as we saw, keeping those credit controls pretty tight.
So here's the final thought for you, the listener, to chew on. If a firm is truly committed to operating within that 3% to 4% RLTC range long term, and if they've built this powerful growth engine around 0% APR products, which naturally have a lower RLTC.
Where does that leave their next move?
Exactly. It's a bit of a tightrope walk, isn't it?
It really is. They're intentionally running hot on efficiency right now, above that 4% target, specifically to fund network growth. So the big question for the next few quarters has to be, how quickly will that aggressive push for more GMV, especially the lower yield kind, bring that RLTC metric back down into their target 3% to 4% range?
And what trade-offs will we see as they manage that? Will they have to tweak merchant fees, change product focus slightly?
Yeah, will they have to, say, reduce how much merchants subsidize those 0% loans to keep the GMV accelerating? Watching that balance the forced growth versus controlled efficiency. That's really the story to keep an eye on.